Scholars, today we are going to talk about chapter number 9, which is responsibility accounting. In this, for this chapter, I picked this question from the end of the chapter: integrating decentralization and performance evaluation system. So we are talking about one subunit of Racer Sports Company had the following financial results for last month. We have a net sales revenue. This is our actual and flexible, and the variable expenses are this 261,000, and the flexible budget was 250. Contribution margin is given, untraceable fixed and expenses, fixed expense or traceable. Traceable simply means you were able to quantify them. And then the segment margin or operating income is the same thing. So we want to know how much we have an increase or decrease in these numbers. So for example, our actual results for sales revenue is 476,000 and our budgeted number is 451,000, which means we have an increase of $25,000. Now, is this favorable or unfavorable? Now you notice this is a sales revenue. Sales revenue budgeted was 451 and the actual is 476. So that means our net sales revenue is gone up by $25,000. Therefore, it is favorable. Our variable expense were budgeted were 251,000, but actual result are 261,000. That means our variable cost has gone up by $10,000. And remember, again, expense goes up, it is always unfavorable. Our flexible budget contribution margin was 200,000, but we end up having 215. So it's an increase of $15,000. So that is favorable. Our fixed expenses were 26,000, but that was budgeted that we're going to spend 26, but in actuality we spent 40,000. So we have a 14,000 increase, of which is unfavorable. So our operating income was 174,000, but in reality we have 175,000. So we have an increase of $1,000, which is favorable. Again, it's an operating income. So what is the percentage of variance? How much change in the percentage? So we have a $25,000 change of 451,000. So if I take 25,000 and divide by 451,000, I get 0.05, and by multiply by 100, that means we have an increase of 5.54%. The same thing for the expense. We take $10,000 and divide that by $251,000. And if we multiply by 100, we have an increase of 3.98%. Now, this is our increase in sales revenue, so therefore it is favorable. This is an increase in expense, so this will be unfavorable. Again, we have a 15,000 increase in contribution margin. So 15,000 divided by 200,000 is equal to 0.075. So we have a 7.5% increase, and it is favorable. And then we have a 14,000 increase in our fixed expense. So we take 14,000 divided by 26,000. This is multiplied by 100. So we have a 53.84% increase, which is unfavorable. UF or UNF is the same thing, unfavorable. And then we have a $1,000 increase. So $1,000 increase over 174,000, that gives us very little number. So this is half a percent, 0.57% favorable. Okay. Now we have to complete the performance evaluation report for this subunit, which we have already done that. So this is our report. Now we have to answer some of these requirements. For example, the first question is, based on the data presented and your knowledge of the company, what type of responsibility center is this subunit? All right. So in this subunit, what you are saying sales revenue, variable expense, contribution margin, fixed expense, and operating income, which means that this is a revenue and cost data. Sorry, it is a both revenue and cost center. So for number 2, it's here it is over here. So it's what type of responsibility? It's a revenue because it has information about revenue and cost. So it has revenue and cost, both centers. Third, which item should be investigated if part of management decision criteria is to investigate all variance to or exceeding $8,000 and exceeding 10%, both criteria must be met. So when we have $8,000 in dollar terms or 10% increase, the only item that we can see that, so 451 to 476 is 25,000. 251 to 261 is $10,000. So that is a criteria covering $8,000. 200 to 215 is a 15,000. So it also has more than 8,000 increase. And 26,000 to 40,000, it also has more than 8,000 increase. Over here it's not. But we also have to take into consideration of 10%. So exceeding 8,000 and 10%. This one is less than 10%. We cannot take into consideration. This one is less than 10%. We cannot take it, even though both are more than 8,000. This one is 15,000 again, but it's less than 10%. This one is more than 10,000, 14,000, and it's also a 53% increase. So we can say the only thing it's matter here is meeting both is the fixed expense. Fixed expense increase more than 8,000 and more than 10%. So that's why we're going to use it. Now, the fourth question is, should only unfavorable variances be investigated? Explain why. We have only two kinds of variances, favorable and unfavorable. Do you want to investigate only unfavorable? No, you investigate both favorable and unfavorable, because both variances tells you what you can do to improve the efficiency and capacity and production for your future. So the answer is we have to investigate both. The next one is it possible that the variances are due to a higher than expected sales volume? So is the variance only happens when the sales volume goes up? Well, when the sales volume goes up, your sales revenue goes up, your variable cost goes up, your contribution margin goes up, but it does not make a difference on fixed cost most of the time. So the answer should be the flexible budget variances are not due to sales volume difference. Variances due to difference in sales are captured by sales volume variance and not the flexible budget variance. So which balance scorecard perspective is being addressed through this performance report? In your opinion, it is this performance report or a lead or a lagging indicator? So in this case, number 7, we have to take into consideration the performance report addresses only financial perspective. financial perspective. And the balance scorecard. And the financial performance measure tend to be lagging indicator because lead indicators are about future. Lagging indicators is about past, and financial perspective is always about past. Okay. Number 8, list one key performance indicator for the 3 other balance scorecard perspective. Make sure to indicate which perspective is being addressed by the indicators you list. So there are customers, other, and internal business, and learning and growth. These perspectives, we do not get information only from the financial perspective. All right. Thank you very much for watching this video. Please let me know if you have any question or comment on this video, and I hope to see you in next video.